614 Startups Nation, welcome to another episode of the 614 Startups Podcast. My name is Elio Harmon, your host. And man, the good guests keep on rolling. I'm in the studio today with my very special guest, my man, Matt Orr of Stonehenge Capital. Matt, welcome to the show.
Thank you, Elio. So happy to be here and appreciate the time to spend with you.
Yeah, man, awesome. I think the first time we connected, we hadn't known each other prior, and I saw this guy on this flyer that I'm going to be talking to, and I kind of read your bio, got me excited to talk to you. That was at Startup Week 2019. It's taken us this long to reconnect, but there's no better time than now, all right? So for the folks out there who don't know you, why don't you start with your personal background, a little bit about your professional work that you're doing right now.
Perfect. So again, I'm Matt Orr with Stonehenge Capital. I've been at Stonehenge for the last 11 plus years, which is going by, feels like an instant. I'm originally from Toledo, Ohio, and came to Columbus to attend. I know everyone says the Ohio State, but it was Ohio State for me at the time. Loved the community, loved the energy here, was really excited about the potential of Columbus becoming a tech hub, even back then with Ohio State's Entrepreneurship Center. And Rich Langdale at NCT Ventures helped kind of spearhead a lot of that as well. So it kind of got me interested just learning more about the space. And ever since then, right out of school, I started working at Stonehenge Capital. And what Stonehenge actually is, they're a specialty finance firm, and everything that they do connects with economic development and finance. So they really kind of connect at this nexus of economic development and finance, where they do private equity, venture capital, growth capital, loans to all types of businesses, but all of those investments have an economic development tint or bent to them. So we, for the last 20 plus years, have invested in various states and federal programs that have mandates to spur certain types of activity. So for example, some of the funds that we've raised and participated in have had a focus to invest in small businesses, in rural businesses, and businesses located in underserved or low income areas. The new buzzword most recently is opportunity zones. So trying to invest in businesses that are located in opportunity zones. And the ultimate goal is really to hopefully try to create jobs as a result of our investments into these companies. And when we make these investments, they can be structured any number of ways. And what's pretty special about these funds is that, you know, one day we can look at a startup and provide convertible debt to help them get to the next point or milestone that they're working towards, or we can provide senior loans for new real estate and manufacturing expansions. We can provide mezzanine or subordinated capital to companies that have been existing for a long time and they're just trying to continue to grow at the same pace. So really it's very flexible and nimble, and we really touch a lot of different types of businesses and different stages of businesses. So we don't just focus on venture capital. It's one of the types of investments that we make across our entire platform. So it's been a really unique experience. And like I said, I've been doing that for the last 11 years. When I started, I was focused more on a federal program called New Markets Tax Credits, which preceded the Opportunity Zones program. And the last 6 years, I've been more in that direct investing role, doing investments between $500,000 up to $5 million across several different state funds for us. Those funds were in Utah, Nebraska, and Ohio. And those investments, like I mentioned prior, could be structured any number of ways. So I got to wear many hats in many of those markets. And what's really exciting is that we now have a new fund where we're looking to do some of that similar work across the country, where we're focusing on helping companies that have already established, they're growing in these underserved areas or low to moderate income areas or opportunity zones, enterprise zones, or any specially designated economic development targeted area. And we can provide debt from 5 to 15 million to help companies grow. And some of the opportunities that we're going to see will be to fast growing technology companies that may be looking for venture debt as an alternative to raising equity, so they don't have to get diluted as much in their subsequent rounds. So that's the quick and dirty of what I'm currently doing, but excited to be with you today.
All right, so you gave us a lot there. Now, if you guys are listening in, grab a pen and a piece of paper because we're going to learn. There are a lot of things there that I think are very nuanced, right? The way Stonehenge approaches finance, that I really want our audience to walk away after listening to this podcast much more educated. You started with Stonehenge, you've been with them, you've grown with the company. I know you've always had decision-making opportunities, but I know you just got a promotion. How has that kind of changed how you operate within Stonehenge? And let's talk about it. And kudos to you on that.
Thank you very much. And I would say right now, my kind of current responsibilities really would be to spearhead and go out and find opportunities that Stonehenge would love to invest in. So I help co-manage a couple different funds with the newest initiative. Me and two other colleagues, we're principally charged with trying to go find companies that fall in these underserved areas that meet our requirements for investment. And again, these are fast-growing, cash-flowing businesses that have a need to continue to grow in these underserved areas. And the capital can be used for any number of things. And right now, I'm really focused on partnering with people that are looking to buy other businesses. So there's a ton of activity with independent sponsors or fundless sponsors in the private equity space looking to acquire different types of companies, with software companies or SaaS companies being I'm working on a deal right now where that's a big focus. And also companies that are already established, that have had a long history, and really they just need additional capital to grow their business to the next level, take advantage of customer opportunities. Sometimes they need new space because they've outgrown their current location. Sometimes when you think about succession planning, entrepreneurs have to do a recapitalization of their capital structure to let new people come into the business so it can keep growing, because the old guard wants to retire and things like that. So there's a lot of interesting reasons of why they need capital, and we're here to kind of find ways to customize solutions that meet those needs. So we're very flexible is what I want to convey, and we look at any number of opportunities. And by nature, we are a generalist investor. So we don't have domain expertise in any one industry, but we always look to partner with domain experts in individual industries to find good opportunities.
Okay. Now, for economic development, it's kind of vague for us who don't work in the economic development world. So I always like to start by not assuming the audience understands when you use a term economic development versus what we might ascribe to economic development just generically. So let's have a definition of economic development. I heard, of course, you're making investments for a return, but job creation is maybe that double bottom line. So how do you look at or define economic development?
So for us, there's a couple of things. So I think in general, like you mentioned, job creation is really a big push for most municipalities when they mention economic development, which ultimately helps them get a new tax base. Or if a business is expanding, they're able to get more taxes from the businesses that are expanding in their areas. For us, that's a big component of what we focus on and track and try to help facilitate. But we also, in the group that I'm in, focused on community development. So it's one step further, where we also look to create jobs in specific communities. And those communities that we want to create jobs in, by definition, are underserved. So they're lower income, they have special needs that they need a catalyst or a push to help get some activity to hopefully help turn around the community demographics, or to provide job creation opportunities for people that principally live in those underserved areas as well. So economic development in general could be any type of growth or job creation in areas, throughout cities and states in the country. But we also focus on community development, which is these underserved areas, trying to create jobs in those areas, which could be a lot more difficult than the affluent areas, as you can imagine.
Okay, so we have our definition of economic development. I like all of those things, right? About creating a return, but also having other impact on the communities that you guys invest in. I love that, including job creation, et cetera. Let's talk about private equity and the definition of that versus venture capital. One of the things that you mentioned in your introduction was this idea of retaining ownership, right? That it's just a different way of investing. So let's talk about the definition of private equity and private equity versus venture capital, traditional venture capital.
Yeah, I mean, perfect. And again, I'm going to overgeneralize, and other people might have different spins or takes, but in general, when we say private equity, we raise pools of capital from investors, and then we go invest into companies, and those investments can be debt or equity. And typically when people use the term private equity, they're also talking about the stage of company. So when someone mentions venture versus private, venture tends to be startups, earlier stage companies that are more in their infancy and growing and becoming validated, and they have hyper growth, but they don't have a long track record of doing that. And private equity typically focuses on companies that are well established. So that could be, 3-generation family owned business that has been a concrete manufacturer for 80 years. That could be a 20-year-old company that focuses on distribution for spirits. It could be a technology company that's been around for 30 years, providing a service to municipalities, which is one deal that I'm working on right now in the SaaS space. So really, private equity tends to work with companies that are already more established. They're proven. A lot of the risk from taking the earlier stage businesses are gone, and they're really looking at providing ways to grow a more established companies is the most simple way that I can describe it. Venture is taking a lot of risks because they have a lot of uncertainty. A lot of times the businesses might not have a proven business model. They might be, before they even make their first dollar in the business, they might not have validated with customers that their product is actually needed or wanted, or is in the type of stage that is useful for them. And there still has to be iterations. There's just a lot more risk because the companies aren't as established. They're not at a stage where they can have the infrastructure to take some of the risk out of the investment. So that's the most simple way I can describe it, how I think about it.
All right. So now you have some dry powder. You're going out into the market and you're looking for companies to partner with, to invest in. What are the things that you're looking for as you're evaluating a potential deal and a potential investment? What are the things that are critical to your decision-making process?
That's a great question. So when we look at deals right now with this newest fund that I mentioned, we're first focusing on the management team and the reasonableness of kind of the management team's credibility. So a couple questions like, how long have they been doing it? What's their track record of success in doing what they're doing in the industry that they're in? When they talk about growth, does the growth sound pie in the sky, or does it sound reasonable and executable from their past successes? So management is always a really big piece, making sure that story ties. If it's a potential acquisition where new people want to come into a company, we're asking those same type of questions, but more so on the side of what's their previous experiences working with companies and helping them grow. When it comes to opportunities with the current fund, we like companies that have at least achieved a positive cash flow. Some investors, that's not a big deal for them, but for us, we do like at least seeing some track record of being able to generate profits or positive cash flow or positive EBITDA for the business. And that's primarily because we have a preference for our investments to do debt, and debt is best suited to be supported by cash flow for us. And then secondarily, we'll look for if the company has grown to a size where they could have assets that can secure our loan. So if they have buildings or accounts receivable or inventory or even IP that can help support the loan that we're looking at giving them. And then the third way out for us is if there's strong partners or people who have deep pockets as well to support the business if they hit turbulent times, or if they have a setback, or if they hit a snag in their business plan. So that's in general. And then from a earlier stage company standpoint, we really like companies that have figured out kind of their product market fit. We like earlier stage companies that have a recurring revenue model because it takes some risk out for us that once they get a long-term contract signed by good blue chip customers, they have a track record of providing good work for those blue chip customers. You can rely upon that type of company better than if they were, solely consumer focused and their products change from a year to year basis.
Mm-hmm.
So in general, we're trying to find companies that are stable from a standpoint of they have a dependable business that has diversification across their customer base, diversification across their supplier base, and really is growing at a nice clip every year. And depending on the industry, that could be, pretty different from industry to industry. But in general, we want to see growing companies that have positive cash flow with strong management teams as a general overarching theme.
All right. So how do you know a good management team when you see one?
From my perspective, and the deals that we worked on in Stonehenge, a lot of times, we're looking at how they've organized their business. And what that can mean a lot of different things, but no one person can run a company by themselves. So when you think about, as we're evaluating a team, some companies that we deal with are on the lowest kind of stage, like they're not that large. So in many cases, they might have a weak financial function, or they might have a weak sales function, or they might have, a weak supporting staff, or basically the CEO or president is doing the majority of all the work in the business. We tend to like companies that have at least started to establish key people to fill those roles, and they're doing a good job in those roles, evidenced by the growth of the business.
Okay. So that's great. I mean, that's simple, right? That's like business 101, right? That you hire the right people, their roles are well defined, you have metrics around those, and they're meeting those metrics, and you can show it, right? That you have a system around your business. And that's really the role of the CEO. Now we're going to get into forecasting in a second, and whether or not forecasting has a sound basis, and then, for all that you can actually evaluate with a forecast, seem probable. And that's a perfect segue into shouting out one of our partners on the show, Book and Street. Every time I talk to Michelle Mersha, she is obsessed, absolutely obsessed with cash flow forecasting. So Book and Street provides finance and accounting solutions for startups in the Midwest and beyond. From strategic financial support to bookkeeping and everything in between, they've got your back office covered. Let their experienced team of finance and accounting professionals help you set up your startup right from the start. Learn more at bookandstreet.com and set up your 30-minute consultation with their team today. All right, let's get into forecasting, my friend. Because when people write their business plan, this is like the most, you could just throw this out, right? They just came up with these numbers somewhere. We're going to start with $10,000, and in 3 years, we're going to be $1 billion company, right? How do you evaluate, to your point, what makes sense from a foundational standpoint? There was some grounding, some research in this, and then what projection might likely to hit a projection? How do you guys evaluate that?
That's a great question. And for, the deals that I've looked at, I've seen kind of a mixed bag of how people approach forecasting. I tend to see when I work with earlier stage companies, they, for some reason, I don't know if it's all the different, Shark Tank companies that are out now and all the different talk around being a startup entrepreneur and growing a business. But to your point, they're always going from 0 to $1 billion in 5 years. And they don't even know who their real market customer is. And I think for us, it's a fine line, depending on the stage of company you are of, if you put a plan in place, it's always really good to set your budget, set your forecast. But at the same time, you have to execute on it. So it's going to be a different kind of conversation with an earlier stage company that doesn't really know their customers yet. They don't really know where to start, but they do know their total addressable market is very big. So they always just assume that if this works, we're going to be a really valuable company. And I think the better exercise from our experience is if you can think about even if you're going to be a fast growing startup company, if you can just think about what is your true path to profitability. So how do you put a plan in place? How do you offer products and services where you can at least get to a profit center or a positive cash flow within a couple of years? Because what they always end up showing is, we're making $1 billion, but they don't think about profit. So if you don't actually have profit in your forecast, that means that you're burning so much cash, you're always going to have to raise money, which means your whole plan is totally dependent upon raising more money in the future, which we can't guarantee that. We can't guarantee that the market's not going to shift on you, investor sentiment doesn't change, and all these different variables that could affect your ability to raise enough money to hit your goals. So in my opinion, and in our experience, we always try to coach earlier stage companies that, yes, make the forecast. Yes, it's a great opportunity, but also put together the plan for, if you can't raise money, how does this business continue? Because if you can't raise money, and if that's your only avenue to grow, then you're going to go under, because your burn rate is just going to overwhelm you over time. So for us, when you talk about the forecast, it's kind of a dual conversation. Yes, it's a good exercise, but you also got to have kind of the secondary thinking as a high growth entrepreneur of, well, how do I actually make money in my business on a unit level? Even if you choose to grow, we know growth means you have to invest a lot into your business, but it's still a really good exercise to think through, how do I actually make money? Which in Silicon Valley and other places, sometimes that can be missed because so many people are successful at raising money in big amounts. They just assume it's always going to be that way. And whenever the market changes, you find out there's a ton of startups that end up going away because they're not well capitalized anymore, and they haven't raised money every 6 months like they were doing prior.
So I feel as if, and you correct me if I'm wrong, but the more I have this conversation with you, I feel like companies that seek the private equity route tend to be more disciplined, right? Because you are constrained to these certain criteria. Solid management team, forecast based in reality, right?
Yeah.
Demonstrating a clear ability to pay back these loans. And so I talked to Kelly Jones of 614 Capital. And she's out of Indianapolis. And what she talks about is what she sees in Black startups, because they know, for some reason, I'm not going to jump to this conclusion, that venture capital is not always their first option, right?
Yeah.
So they tend to bootstrap and bootstrap longer. And typically when they're walking through her doors, they have that discipline. They have more of a path to profitability because they've had to actually bill clients in order to pay bills, right? They usually are on their way to profitability. Have you seen that as you are evaluating deals, particularly if you're looking at investments in underserved communities, which tend to be, in some cases, majority Black neighborhoods, or have maybe majority Black entrepreneurs operating in those areas?
That's a really good observation and point. I would say, especially for the types of opportunities that we see, there tends to be, hyper growth companies, especially in the technology sector. They tend to gravitate to where all of I call them the cool kid areas are. So they want to be part of an ecosystem that perpetuates and helps them attract, strong, fast growing talent that likes the startup space, likes the startup culture. And in the companies and areas that we target, to your point, they do tend to be more bootstrap oriented. They tend to be more conservative with how do they actually approach, building their business, because they know by definition, access to capital in these areas isn't as prevalent as other areas that are more affluent. So all the data points to that. That's why there's a need. And that's why, we've been doing this type of work for 20 years, because these markets are underserved for many reasons that we don't have time to get into, but that's kind of part of helping these companies in these areas. So they tend to need the capital to grow to the next level, but that capital isn't going to be used in a way where they think they're going to get hyper growth like a traditional tech startup would.
Mm-hmm. All right, listen, time is flying on this podcast. I'm already going to put an ask out there that you come back for part 2 of this conversation because I'm deeply interested, right? But we're going to wrap this thing up. I have only a few more questions for you. You're out there actively looking for deals. You've already told people what you're looking for, but when somebody is approaching you, right? They hear about Stonehenge, they listen to this podcast, they feel like they are a good fit, or at least they want to get more information. What are some things that you like them to come to the table with, right? Be ready to have the conversation with. What are those things that you need from them?
Yeah, I think, again, that's another good question. For me personally, when I, get inquiries from different types of companies, I normally, will have a conversation with them, but really I would want them to at least be able to describe to me kind of the quick bullets in an executive summary format. So at least have, what's your general company, what's it doing, what type of products do you make, have a decent handle on the opportunity that you're raising money for. Because sometimes people think they just want money just to have it, but really they don't need it yet, based upon where they're at. Because a lot of times the money that they need, they're kind of looking to other people to help coach them, but they're just not at a point where they need a large check to get to the next level. They need to take some other steps. So for me, it's executive summary. It's having a decent handle on your financials. That'll be the first thing that I'll ask. What are your current financial profiles? So your last 12 months of financials broken out monthly gives me a good sense how the business ebbs and flows over the course of a year. And then if you have a longer history than a year, then I would ask for a couple years of financials just to kind of have a general sense of what the business has done. And then I can size it up pretty quickly and give them feedback on, this is how we would look at this opportunity, and these would be the next steps for us in general. A lot of times, depending on our funds, if it's an earlier stage company and they are pre-revenue, I like to be value added to our ecosystem, which includes the startup community. I still have those conversations, but it's more of, hey, let's keep in touch over a 12 to 18 month period. Because if you do hit your numbers, if you hit your plan, then you can be at a point where we can have a more serious conversation. So it's kind of a fluid back and forth depending on where the company and the entrepreneur is.
All right. Don't get in your feelings if you call Matt and he's like, let's keep this conversation going. All right. He's going to provide you with what you need. You could learn, you can grow, but hit your numbers. That's the main thing, right? You hit your numbers, you make Matt's job a lot easier in order to give you the money to keep scaling. All right. We're going to take one more break, Matt, and then we'll talk about how folks can get a hold of you. All right. At 614 Startups, I'm trying to put people in position to help me succeed to scale. So if I ever do come to Matt, he can look at my management team and says, this guy is really taking my advice to heart. All right. And we're going through a lot of changes. Some of these changes include a new website, a rebrand, updating and marketing and growth strategy. Undertaking all the marketing that you can do as a founder or even with a team can be so overwhelming. Tell me about it. So naturally, we turn to our sponsor, Studio MFP, for help in order to take our brand and marketing to the next level. Of course, I was worried about cost, how much time it would take, and even the level of commitment I needed to take on since I was running everything else here at 614 Startups. But Studio MFP has taken care of everything. In just our first hour together at Studio MFP, I really felt confident and relieved that I could rely on them as our marketing and growth partner. So check them out for a free consultation, studiomfp.com, and start growing your business today. All right, Matt, I'm sure people have heard this podcast. They're excited about getting a hold of you. What's the best way to contact you? Is it through your website, social media? How do they get a hold of you?
Yeah, so my email address is just msorr at Stonehenge Capital. So MSORR at Stone, STONE, Henge, HENGE, Capital, CAPITAL.com. And then also I'm pretty active on LinkedIn. So that's a really good way for me to kind of see your website, see your background in a quick usable format. So if you want to reach out or touch base on LinkedIn, I'm usually pretty responsive on that as well.
Great, Matt. Thank you so much. This is only part one, man. You got to come back on. I have like 50 other questions I want to ask you And folks, get a hold of Matt. Even if you're not kind of where he says you need to be, he's willing to give back to the community. He wants to have conversations with you. Maybe you're just 1 or 2 conversations away from where you need to be, and he has the experience to give you that advice. All right, folks, that's a wrap. You can find this and all episodes on our website, 614startups.com, Apple Podcasts, Spotify, Anchor, and all your favorite podcasting platforms. Don't forget to subscribe and write a review. If you'd like updates sent to your inbox, you can also sign up for our weekly newsletter on the website. Stay engaged with us. This is a community. You can follow us on social, on LinkedIn, Twitter, Facebook, Instagram, at 614 Startups to join the conversation. For sponsorship opportunities, you want to break that bread with us and collaboration, email us at info@614startups. Until next time, peace.